If you are an executive that makes W-2 comp, your company may eventually present you with the opportunity to participate in what's called a non-qualified deferred comp plan, sometimes also referred to as a top hat plan. But these plans are unique. They cover just executives. They do not operate like 401k, other type of employer-sponsored retirement plans. They have their own set of rules, and we're going to be going over today how these plans work, how the tax implications are, and the elections that have to be made when you enter into one of these plans. First, what are these plans? So as the name suggests, a non-qualified deferred compensation plans allows executives to deferred compensation they otherwise would receive now at a very high tax rate and defer that at some point in the future. But again, these are not ERISA-based plans. There are risks to the executives that if the company were to go under while they were still employed by that company, they could completely lose that benefit. Let's first cover who's eligible for these types of plans. So literally the company can handpick who can participate in this top hat plan. It's not like 401k world where once you've been employed for a year and you make a certain level of comp, then you're eligible to participate. Usually companies can handpick who can participate and not participate in these non-qualified plans. For high earning executives, the other attractive feature of these non-qualified deferred comp plans are there's no contribution limits. So unlike 401ks where they say, hey, you can only contribute $23,500 and then you're shut off, with these non-qualified deferred comp plans, it is dictated by the plan how much these executives are able to defer, but can be well in excess of those 401k limitations. There are two different ways that contributions are usually structured for these plans. The one is the voluntary employee contribution, which essentially the company comes to the executives at the end of the year and says, hey, we were going to pay you an extra $50,000 next year. Instead of taking that in your paycheck when you're already in a really high bracket, you can make this election to say, don't pay that compensation to me now. Pay it to me after I've already retired or left service with the company when hopefully I'm in a lower tax bracket. But every year that employee makes that election, usually there's a choice that has to be made. Sometimes they'll say, hey, there's multiple ways this can get paid to you in the future. Sometimes there's a lump sum option, which means upon a triggering event, whether it's 10 years in the future and then it's paid, or it's after you separate from service, that's like a trigger event where that full amount of deferred compensation is paid to the employee. Or they may elect, let's say, a 10-year even payout where instead of getting that amount in a lump sum after the left service, they get paid a tenth, spreading that out over a 10-year period as opposed to getting it all in a big chunk lump sum, which is also the biggest mistake we see executives make. They just kind of blindly check the box lump sum, and they've been doing this deferred compensation plan for the last, let's say, 5 to 10 years, and then they leave with their employer, which then triggers all this compensation to be lump sum taxable in a single year. Well, the whole idea was, hey, I'm going to push this compensation to a year where I'm going to pay a lower tax. But if all of a sudden you have hundreds of thousands of deferred comp being taxed within 60 to 90 days after you leave an employer, you might have defeated the whole purpose of having that deferred compensation to pay that comp at a lower tax rate. But it's very important to acknowledge that with these deferred compensation plans, in order for this plan to work, the assets that the company may or may not be using to fund that plan has to be accessible to the company's creditors, which means if that company goes out of business, and let's say that compensation was deferred into the future, all that deferred comp could be completely gone to that executive. This is where I sometimes see executives get confused because companies will decide to fund their non-qualified deferred comp plan, where if an employee decides to defer, let's say, $30,000 of their pay, it'll actually go into like a Fidelity account and that employee can invest it. So it'll look very similar to a 401k, but the difference being if that company goes insolvent, the 401k is protected, but that non-qualified deferred comp plan is not. How is this money taxed when it gets paid to the executive? So it's taxed just like ordinary income. There's no special capital gains treatment regardless of what it's invested in while it's with that employer. When that money gets distributed out, whether it's a lump sum or while it's accords to a laddered installment payout, it is taxed as ordinary income to that executive. These executive deferred comp plans could also be 100% funded by the employer, where instead of the employee making an election on their own comp, the company just says, hey, every single year for the next 5 years, we're going to put $50,000 away, and in year 5, that's when you're going to be 100% invested, so you can receive that $250,000 in extra comp. But if you leave any time within that 5-year period, you get none of it. The important thing to understand in non-qualified deferred comp rules is vesting and taxation happen hand in hand. As soon as an employee is vested in their deferred comp, meaning they can take it, that's when it becomes taxable to the employee and tax deductible to the employer. These plans are a good fit for some executives and not a good fit for others. So executives these are a good fit for are executives that are high W-2 earners that have already maxed out their other retirement plans and want to be able to save more on a tax-deferred basis. Second, executives with predictable long-term tenure with the company because they got to be employed there usually to vest in the benefit. Third, those expected to be a lower tax bracket in the future when they vest. Otherwise, what's the point of the deferred compensation plan? And fourth, executives that are employed by financially strong companies because they have to believe that the benefit is going to be there when they vest in that benefit. However, there are definitely situations where the executive may want to take a pass on this non-qualified deferred comp plan. Number one is if they're not expecting to be with the employer for a not long enough period of time to actually vest in that benefit. Number two, if the company is not financially stable. Remember, the creditors have to have access to the deferred comp dollars so they could completely lose it in a bankruptcy. And number three, if that executive were to need access to those funds prior to the vest date, they might prefer to say, give me the compensation now and pay tax in it as opposed to having to wait for it in the future if they can't wait. Another key thing to making this non-qualified deferred comp plan work is you have to have W-2 income. That's what's being deferred to a future year. If let's say you're a partner and you're getting a K-1, there's no way to defer that compensation from the K-1 partnership into a future tax year. These non-qualified deferred comp plans, when designed correctly, can be a huge benefit for both the employee and the employer. From the employee standpoint, because they can push some of that comp, hopefully in the lower bracket years. From the employer, it's a way of almost a golden handcuffs that allows them to keep their executives around for a longer period of time, realizing if they leave, they're going to lose that carrot that's sitting for them maybe 5, 10, 15 years down the road. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.